Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. We have this first question from John, who says, I'm approaching retirement, but I think I've been too aggressive for too long. So when the market comes back, I really want to change that approach. What do you think? All right, John. Well, I agree with most of that. Most of that makes sense. I agree that you need to change that approach if you know you waited too long. The question is, should you wait for the market to come back? Now, I don't think this is necessarily another, bursting of the tech bubble like we had in the year 2000. But even if, it was less severe, right? In 2000, the market was, underwater for 13 years. So John, if it happened once, tells us it can what? It can happen again. So it can happen again, and the reality is that do you really want to work 13 more years? Or even if it's half that, do you want to work 6 or 7 more? So, just to come back and meanwhile, you're underwater, right? It's gonna, by the time it comes back, 6 or 7 years, right? Zero growth at the end of the day, right? So we always compare our accounts to the high water mark, right? What's the highest value it was? Oh, if I can only get back there, right? And people do this in the casinos, right? They come in with $500. They're up to $2,000. Then they give $1,000 back. And instead of being happy they're up 500 from where they started, they say, well, if I can get that 1,000 back and go up to 2,000, I'll quit. And the reality is that it's misguided to look at the high water mark. What I think is important, for you to look at the amount of money, right, you have right now. And if you were to switch to an income first, growth second approach, can you live a retirement that anywhere near resembles what you want? And if it does, then maybe doing it now and not waiting for that recovery is a smart move, because the market right now, in order to get from, where we are to back the high water mark, is probably another, call it 15, 16% gain, something like that. And that may happen, or we might go down another 16 or 20%, right? Or we may just stay where we are. The bottom line is, if you're earning a 4% income stream, after 4 years, you've made that 4% back in just 4 years of income, right? 4 times 4 is 16, right? Here's something else to consider. When you're approaching retirement, the reliability of your income becomes far more important than chasing returns. Think about creating what I call income buckets, different sources of predictable cash flow that can sustain your lifestyle regardless of market fluctuations. This might include dividend-paying stocks, bonds, annuities, rental properties, other income-generating investments that align with your risk tolerance. So yes, you need to make the change, but I'm questioning whether or not it makes sense to wait for it to come back, or maybe just do it now. If you're close enough, it may make sense to make some of that money to, maybe take it off the table, so to speak, and start investing for income now. Because remember, income is another form of growth. Those reinvested interest and dividends, right? That's growth. And remember, just because you go to an income first strategy doesn't mean you need to be completely out of the stock market. In fact, far from it. Many of my clients who successfully transitioned to retirement during volatile markets did so by gradually shifting portfolios or portions of their portfolio to income investments rather than trying to time the market exit. This approach gives you the best of both worlds. You're kind of securing reliable income while still maintaining some growth potential as you enter this new phase of life. Great question. As always, if you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. Let's get on to our second question from Ashley. Now she says, what do you think about tips? All right, Ashley, thanks for bringing up Treasury Inflation-Protected Securities. It's an interesting topic, and there's a few considerations to unpack here, especially for retirees looking to manage inflation risk while focusing on income and stability. Tips, Treasury Inflation-Protected Securities, are bonds issued by the US government designed to provide protection against inflation. They adjust their principal value based on changes in the Consumer Price Index, the CPI, ensuring that investors receive a return that keeps pace with inflation. Now, while this feature sounds appealing in theory, there are practical limitations that warrant scrutiny. Firstly, an annual purchase limit for tips is capped at $10,000 per individual through Treasury Direct. Now, for retirees with substantial retirement savings, this limitation may restrict the ability to allocate a meaningful portion of their portfolio to tips. While it can serve as a modest hedge against inflation, its impact on a diversified retirement portfolio may be limited due to this purchasing constraint. Now, philosophically, some investors, myself included, have reservations about tips. When you invest in any bond, including tips, you're essentially lending money to the government or institution issuing the bond. With tips, the interest rate adjusts based on inflation determined by the government, right? Without your input. So this arrangement means you're at the mercy of the government's inflation rate decisions, which could potentially lead to returns that don't fully offset inflation's impact on your purchasing power. Moreover, consider the government's incentive to keep inflation in check. While tips are designed to protect against inflation, the government has a vested interest in maintaining low inflation rates to manage its debt obligations effectively. So this kind of dynamic can create a situation where you're essentially betting against the government's fiscal policies, which may not align with your financial goals in retirement. So in practical terms, while holding some tips can provide a degree of inflation protection, especially in times of rising prices, their utility may be limited by both the annual purchase cap and the inherent risks associated with government-controlled inflation adjustments. For retirees seeking income with reduced risk and volatility, exploring a diversified portfolio that includes a mix of assets like high-quality bonds, dividend-paying stocks, possibly alternative investments, that may offer a more comprehensive approach. These strategies can provide steady income streams while mitigating the impact of inflation over the long term. Tips. Interesting question. Thanks for the great questions. As always, if you would like to send in your question, you can do so by emailing them to poolelocke@poolelocke.com. And if you like what you heard today, go ahead, like and subscribe to our channel. I am James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.